Welcome to Iron Financial. We're here to help you forge a stronger portfolio and cut straight through the market weakness. I'm your lead analyst, and today we're tearing into a retailer that just delivered an absolute blowout quarter. The TJX Companies, ticker TJX, just dropped their Q1 FY2027 earnings, and honestly, the numbers are staggering. We're talking about massive top and bottom line beats that practically prove their off-price engine is running at absolute peak efficiency and their structural foundation is stronger than ever. Okay, hold on a second. I'm the market skeptic, and it's my job to ask the hard questions here. Look, the retail sector is a brutal place right now, right? Inflation is sticky, credit card debt is maxed out, and consumer wallets are literally shrinking by the day. So if this quarter was such a powerhouse, why didn't the market reward it? We really need to figure out if this is an ironclad opportunity to build a solid foundation for your portfolio, or if we're just looking at a value trap disguised by some temporary macroeconomic tailwinds. Essentially, is this hype or is it real? That is exactly what we're going to deconstruct in this explainer. We're going to stress test their balance sheet, drill down into the segment margins, and lay out the exact trade setup you need to know. Let's start right at the bedrock. This quarter was rock solid. TJX reported a diluted earnings per share of $1.19. That's up an incredible 29% year over year, and it completely crushed the street's estimate of $1.02. That is a 17% beat on the bottom line. You have to understand just how rare a 17% earnings beat is in the current retail climate. Most legacy brick-and-mortar stores are barely scraping by, or they're actively cutting their guidance. And TJX didn't just engineer this with fancy financial gymnastics, they drove it with real, tangible revenue. Net sales came in at $14.32 billion, up 9% year over year, beating the $14.0 billion consensus. Listen, when you have a company of this sheer mammoth size accelerating its revenue growth for 7 consecutive quarters, despite all those consumer headwinds you mentioned, you're looking at a structural fortress.
Okay, those are heavy-duty numbers. I will absolutely give you that. But here is the crack in the armor that we simply cannot ignore. Despite that massive 29% EPS beat and a clean sweep across the board, the stock actually dropped 1.2% on the day of the release. The market sold the news. Now look, sell the news events are incredibly common during earnings season, especially when a stock has run up ahead of the print. Wall Street looked at this massive beat and basically said, thanks, but we're taking our profits. But we really have to ask ourselves, if the foundation is genuinely so strong, why did the institutional money walk away? Are they seeing a structural weakness in the back half of the year that retail investors are completely missing?
Section 1. Drill down. The fundamentals. That is the multi-billion-dollar question. And to answer it, we need to dissect the raw fundamentals of this print. We need to see if this growth is actually built on a solid foundation of operational excellence, or if it was just propped up by macro luck. We're going to look straight at the sales data, the traffic, and the customer demographics to see how this building is actually being constructed. The comparable sales metric is a perfect place to start. Q1 consolidated comp sales increased by 6%. That was well above the company's internal plan and light years ahead of expectations.
But look right across from it. Management issued Q2 comparable sales guidance of just 2 to 3% and total sales guidance of 4 to 5%. The Q2 revenue midpoint of $15.05 billion is actually 50 basis points light compared to consensus. That's exactly why the stock dropped. You don't post a 6% comp and then guide down to 2% unless you're seeing a slowdown in real time, right?
Or you do it because you're a seasoned, conservative management team that knows exactly how to underpromise and overdeliver. In a highly volatile macro environment, giving yourself a massive cushion protects the stock price from unnecessary downward shocks. They're leaving themselves plenty of room to beat again. And this brilliantly illustrates why that 6% comp is as ironclad as it gets. CEO Ernie Herrmann explicitly stated on the earnings call that the comp store sales increases were driven equally by a higher average basket and, crucially, an increase in customer transactions, so it was driven by real foot traffic. You really need to understand the trap most retailers are falling into right now. They're just relying on inflationary price hikes to mask bleeding volume. That price-driven growth always hits a wall when the consumer finally taps out. But TJX is actually bringing more individual humans through the front door. That's the absolute cleanest read on organic consumer demand you can get. It's traffic-driven, not price-driven.
Sure, they have foot traffic, but who exactly is walking through those doors? Is this just a temporary surge of cash-strapped high-income shoppers trading down because inflation is squeezing their wallets? Because if so, the exact moment the macro environment improves and inflation cools, those shoppers go right back to their premium full-price retailers, and this whole foundation crumbles. Not according to the data. Management confirmed that customer growth was actually consistent across all income demographics. They aren't just catching a temporary trade down.
Furthermore, they're disproportionately acquiring Gen Z and millennial shoppers relative to the general population. Let me tell you, capturing younger demographics is the absolute holy grail for a legacy brick-and-mortar retailer. It means they're forging lifelong loyalty with the next generation of consumers, essentially securing their foundation for the next 20 years.
Section 2. Drill down. Heavy lifting.
We need to look at the specific business segments that did the heavy lifting to forge these Q1 results. Because a true structural advantage isn't reliant on just one single pillar. It requires strength across the entire framework. And just look at this structural integrity. Every single division posted positive comparable sales growth. Marmaxx, which is their biggest U.S. segment, including TJ Maxx and Marshalls, was up 6%. HomeGoods surged a massive 9%. But pay really close attention to the international numbers here. TJX Canada grew 7% and TJX International grew 4%. They even just opened their first store in Spain during the quarter with a terrific customer response. This proves the off-price model isn't just an American phenomenon. The strength is incredibly broad-based globally. It's not just one lucky department carrying the weight, the entire off-price engine is firing on all cylinders worldwide.
Okay, top-line growth is great, but did it actually translate to the bottom line? Or did they have to heavily promotional price their way to those sales, completely destroying their margins in the process? Oh, it translated beautifully. The overall pre-tax profit margin jumped 170 basis points to 12.0%. Look closely at HomeGoods. Their segment profit margin exploded, up 270 basis points to 12.9%. Marmaxx was up 100 basis points to 14.7%. This was driven by a massive 180 basis point improvement in gross margin, which hit 31.3%. They leveraged their fixed expenses beautifully against that top-line growth. In retail, fixed leverage is literally everything. The rent for the building and the electricity for the lights cost the exact same whether you sell 10 shirts or 100 shirts. So when foot traffic drives sales up, every extra dollar falls straight to the bottom line.
Wait a minute, I'm looking at their balance sheet right now, and inventory is up 8%, with a 7% per store increase. Now, in traditional retail, ballooning inventory is usually a massive red flag. It usually means stuff isn't selling, warehouses are stuffed, and heavy, margin-crushing markdowns are coming. How is this not a major liability for them? Because you have to understand the specific mechanics of the off-price model. This isn't stale inventory they can't sell. This is strategic hoarding of top-tier closeout goods. Picture this. When full-price retailers panic because they over-ordered and the consumer softens, they are desperate to clear their warehouses. All that excess premium merchandise flows straight to TJX buyers at pennies on the dollar. Management literally described merchandise availability in the market right now as off the charts. The bigger TJX gets, the more attractive they are to vendors desperate for liquidity. So this 8% inventory bump isn't dead weight. It is high-margin fuel for their future sales.
Section 3. Drill down. Debt and hedges.
All right, you've defended the income statement and the inventory strategy pretty well, but I want a true stress test of the balance sheet. If we are actually entering a deeper macroeconomic weakness, can this company's financial structure genuinely withstand the pressure? Let's talk about scale, because the crucial point here is their sheer free cash flow. TJX has about $2.9 billion in total debt. They have 2 upcoming maturity tranches, $1 billion coming due in FY27 and another $500 million in FY29. Now, compare that $1.5 billion in near-term obligations to their raw cash generation engine. TJX generates roughly $4 billion in annual free cash flow after capital expenditures. $4 billion. They ended Q1 with $5.6 billion in cash on hand. This balance sheet is practically bulletproof. They could pay off all their upcoming debt in cash tomorrow morning and still have billions left over to deploy back into the business or return to shareholders.
And this brilliant analysis from the Tippy College of Business highlights the hidden structural strength of their operating model. It shows that TJX operates with what is called negative working capital. Just let that sink in for a second. Current liabilities, specifically accounts payable, actually outweigh their current assets. What does that mean in plain English for the retail investor? It means TJX takes the merchandise, puts it on the rack, the customer buys it on a Tuesday, and TJX collects the cash immediately. But TJX doesn't actually have to pay the vendor who made the shirt until next month. They are effectively getting massive, zero-interest loans directly from their own suppliers to run their daily operations. It is one of the most durable, cash-efficient models in the entire retail sector.
Okay, I admit the vendor financing is a powerful dynamic. But let's go back to that massive margin beat you were bragging about earlier. According to the Ticker report, a significant portion of that 180 basis point gross margin beat wasn't just operational brilliance or fixed leverage. It was actually a lucky fuel hedge. The commodities market just moved in their favor.
If you strip out the favorable inventory dynamics and the fuel hedges, how much real, repeatable structural growth is actually there?
Section 4. Cracks in the armor, the bear case. This is exactly where we need to expose the real risks. The market sold this news for a reason, and we need to look at what is hiding in the back half of the year. Here is the bear case laid out plainly. First, the Q2 revenue guide midpoint of $15.05 billion was 50 basis points light of consensus. Second, management explicitly stated they are embedding current high fuel costs into the remainder of the year. That fuel hedge tailwind that saved their Q1 margins, it's fading fast. If diesel prices stay elevated and the hedges wear off, does the whole margin structure just collapse in the back half of FY2027?
Let's read exactly what CFO John Klinger said about this. We did not flow the entire first quarter pre-tax profit and earnings per share beat to the full year, as we are now planning current fuel prices to remain in place. Look, they beat Q1 EPS by 20 cents against their own guidance, but they only raised the full-year guide by 13 cents. That 7-cent differential isn't a crack in the armor, it's a meticulously engineered shock absorber. This is classic conservative management building a massive margin of safety into their public projections. They are assuming a worst-case scenario. If fuel stays high, they're fully covered. But if diesel prices actually fall, they have massive upside to profitability that simply isn't priced into the stock yet.
Section 5. The verdict, ironclad opportunity. We've stressed the foundation, we've examined the raw materials, and we've pressure tested the balance sheet. Now it's time to bring all the data together for the final verdict. Is TJX a value trap, or is this an ironclad opportunity to build wealth? Well, management is definitely putting their money to work to answer that. They just announced a 13% hike to their quarterly dividend. This marks their 29th dividend increase over the last 30 years, a 20% compound annual growth rate over that time. On top of that, they returned $1.1 billion to shareholders in Q1 alone, and they increased their massive share buyback program to a range of $2.75 billion to $3.0 billion for the fiscal year. Companies only initiate $3 billion buyback programs if the internal data tells them their own stock is deeply undervalued by the market. They're buying their own stock aggressively because they know the foundation is rock solid.
Let's talk targets then. The TIKR valuation model paints a pretty bullish picture, throwing out a mid-case price target of $211.09 by January 2031, which implies roughly 34% upside from current levels. But to hit that, the model requires TJX to sustain 9.4% net income margins long-term, and it assumes a PE compression of negative 1.3% annually. Let's translate that. PE compression basically means the market is actually going to be willing to pay less of a premium for these shares over time. So the stock only gets to that $211 target if the raw underlying earnings growth does all the heavy lifting, without any help from multiple expansion. So, give us a concrete strategy here. How do we actually trade this?
Here is the blueprint based on the charged alpha analysis. Do not chase this stock into the stratosphere. The stock closed around $157 after earnings. This is your initial buy zone. If macroeconomic weakness causes a broader market pullback, treat $145 as your heavy accumulation zone. Scaling into a position at $145 allows you to average down, building a thicker, much stronger cost basis foundation. We would definitely avoid chasing the stock above $180 right now, as the risk-reward ratio starts to tilt unfavorably. But the core thesis remains absolute. Every single time a full-price retailer overorders and panics, this off-price engine just gets stronger.
So there you have it. The foot traffic is real, the balance sheet is basically financed by zero-interest loans from their own suppliers, and management is aggressively buying back shares while strategically sandbagging the back half of the year. They have the traffic, they have the supplier-financed balance sheet, and they have the cash. The only question left is, are you ready to forge your portfolio with TJX, or will you let temporary market weakness shake you out of a structural fortress? Thank you for joining us on this explainer, and we will see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.